Welcome to the Roetzel Health Law Hotspot. Health Law Hotspot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the Health Law Hotspot. I'm Ericka Adler, shareholder and Health Law Group practice leader at Roetzel & Andres, and I'm joined by David Hochman, who's also a shareholder at Roetzel & Andres and part of our Health Law Group. He is also head of our Chicago office. Today, we are talking with Evgeni Ivanov, who is manager in Wipfli's healthcare practice with over 10 years of experience in providing tax services. He's attuned to the tax needs of various healthcare clients, from startup businesses to established companies and individuals. In addition, he also advises his clients on the tax implications of mergers and acquisitions and choice of entity. And we're really excited to have you with us today, so thanks for joining us. Today, we're going to be talking about kind of a little bit of a more technical topic than we usually cover, which is really about the advice that you as a tax specialist give your clients in terms of either selling their practice to a buyer, whether that is to another provider or perhaps a private equity or a hospital, and what kind of advice you're giving them both to get set up to do that in the future or for an immediate sale, and then kind of what some of the steps are that they should be thinking of down the road if they're not quite ready, but it's something that's on the horizon that they're thinking about. So a little bit of an interesting and more technical topic. So why don't we start off with you talking to us a little bit about some of the topics that you discuss with your clients when you're really thinking about, I don't want to call it an exit strategy, but perhaps that's exactly what it is, and how you advise them when you're thinking about the future.
Thank you, Ericka. Thank you for having me. It's my pleasure being on this popular podcast from what I hear. Selling a business, it's not just one straight answer. We first start with we need to ask our clients why they want to sell. What's their goal? What's their plan? Is it retirement? How do we plan for that? And people have different life goals. Some of them just don't want the responsibility of running the practice, or they want to retire in a few years, or they want a big payday. There's various reasons for that. There's a few different ways to sell a practice too. Do you just sell to another physician? Do you sell to another practice? Or what is getting really popular the last few years is private equity. How do you structure that? It also, the why private equity is becoming more popular is they probably can pay the most money at this point. And you have to start the discussion with what they're looking for. What's their goal? Where are they in life? So there's a lot. Even I'm sure COVID changed a lot of people's plans. Also, I had a client who just went on vacation, decided to retire, never went back. So
we won't get into the legal issues with that.
No, but that was an interesting story when he told me. He's like, hey, I went on vacation and this happened and I decided to retire.
So Evgeni, private equity transactions are usually, for a lot of reasons, more complicated, not the least of which is the fact that in Illinois and in most states, you have to be a licensed physician, for example, to own a medical practice. And so how do you structure a transaction to comply with the corporate practice of medicine doctrine that might be applicable in that state? And what's commonly done is to take the tangible assets of the practice and put them in a separate entity that then enters into a management services agreement with the medical practice. So that's the easy part. But now you come to a variety of tax issues where you have private equity buyers who are looking to use some tax strategies that are beneficial to them, but in a lot of cases are also good for the seller. So would you want to talk about those a little bit?
Yes, of course. I'll start with that this is a long process. The selling the practice doesn't just happen like that. It's overnight. usually when our clients, the physician practices, they decide to sell, and once they determine what's their best option, do they want to go the private equity route, which most of them do nowadays, you start organizing and you practice and getting ready for that transaction. And the first step is you just create usually another S corp. You make the election, you roll the old one into it, and start getting ready for the private equity. Now, all that is tax-free, and the ultimate goal is to defer the taxes or save on taxes as much as possible. Now, a lot of how these private equity transactions are structured qualify for capital gain treatments in most cases. And that is good for the seller. Sellers usually look for capital gain treatments, which as of now have preferential tax rates, 15-20% plus 3.8% of net investment income tax, compared to ordinary rates that the salaries are taxed at. And the private equity, they like it. They're able to do their transactions to where they can get basis for the money that they put in, and maybe take a deduction in the future. And that's the summary of it. We can't get into detail. We usually need to see every transaction. Right. So this is the gist of it.
So with the possible increase in capital gains rates next year, have you started to see people who are rushing to get transactions done by the end of 2021?
No, I myself haven't seen any rush, because it's not something that you need to rush, and we still don't know if it's going to happen for certain. There is a lot of talks back and forth. I know that's the goal, but and you don't want to rush. You need to make sure the transaction is structured correctly. So maybe trying to save on the capital gain treatment can lead to bigger problems. So I haven't seen any myself.
Is there still enough time left? If somebody came to you today and said, I want to sell to a private equity firm and close this year, is it actually, you think it's possible to still do it this year? Or are we now at a point where, because of the lead time it takes to get these done the right way, that it would be very difficult? Doing it by the end of the year would be really problematic.
Now, if they started with the restructuring, let's say before, and there at a certain point where they have the new S corporation founded and made the last election, you have the practice rolled into it, you make a QSUP election there, and sometimes some of them even have the MSO already founded, and maybe they have a few buyers here and there, maybe. But if you haven't started all that, I don't think there's enough time with the 3 months that we have left, 4 months.
So another topic related to the private equity buyer is some private equity buyers are interested in having the current owners of the practice retain some equity after the sale. And what's the tax benefit to, what's the tax ramifications to a seller if they're able to do that?
Now, sellers will, most of them should be happy with that structure. Now, private equity wants that. They want to make sure the practice is successful. They want to make sure that the physicians that sell keep, let's say, doing their job the way they used to, and not just cruise and just collect the salaries. Now, the physicians, the sellers, what happens is that part of their equity that's rolled into the private equity, the MSO structure, is not taxed until it's sold. They will be taxed on the rest of it, but that portion of their shares will be tax deferred. And what else they're hoping for is that the value of that MSO will grow. So in a few years, when the private equity is actually ready to sell, again, they may get even more return for their value. So they defer their tax, and it's an option to collect more cash at the end.
I guess one thing I'll mention is there's somewhat of a risk. So if you're offered X amount of money and you're taking part of that purchase price in equity, we hope it goes up, but it may not. So you may have actually left money on the table. That's one thing to be careful of. And I find a lot of these private equity companies are not so open about sharing financial information. It was sometimes hard to assess whether it's a good deal or not. So we always, like to advise our clients to just be kind of cautious about how much they're rolling over. If they're really looking for that big payday, they're putting money at risk. Maybe they prefer to use other investments to do it. But the private equity company likes them to be invested because they feel then they're more invested in the vision of the deal and the success of the company as a whole, which is important as well. One other comment I just want to make is that when we talk about creating a new corporation and kind of rolling things over into new corporation, we're really talking about tax stuff right now. So just want to mention for anybody listening that there are some legal and pay or contract type things as well that are implicated by doing it that way that we're not going to get into. So we're really kind of, just in case anybody thinks, we forgot to think about that, we're just really kind of talking about the tax issue. And one final thing is that, believe it or not, this has been a crazy year for private equity deals. So we have some that have just come in the door this week where they are looking to close by the end of the year. I think you're right, though, it's going to be really tough, but some people are just really fixated on getting it done in 2021. So is it too late? Probably not. Are you going to maybe kill your lawyer getting it done? Potentially. So we'll see, right? But, one of the alternatives when we're talking about practices is some people have, deals set up where they have younger doctors who are set to buy them out. And that might lead to them getting a severance payment. And then we might have instead an offer come in where it's a lump sum. I know there's good capital gain treatment, and I don't pretend to really understand a lot about tax, but when we talk about getting severance over time versus a lump sum payment, if those turned out to be not such different numbers, how does the tax difference make, when you're talking to your clients, is the capital gain still the better way to go? Or is there a direction on that?
Well, if you have a payment over time, you defer the taxes when you receive the payment. So you don't pay the taxes right away. And if you don't need the cash right away, that's an option to go with. But I wouldn't recommend that with private equity. Just take your cash when they give it to you. If there's another doctor trying to buy you out, you're basically making that person a favor by not asking for the cash up front. It works for them and it works for you, and you're saving on deferring the taxes. And now if the rates change, you'd have to take a gamble. Do I want to do it all now when I know what the rate is, or do I defer and possibly pay the highest rate? But maybe once you sell, your income will be lower and you're not going to be subject to the high rate. So there's a lot of planning that can be done. We will look into what other sources of income you have and what was the best strategy, and that works for both of them.
Now, Eric, going back to your point about the wisdom of taking rollover equity, the other factor that plays into this, a lot of private equity firms they don't buy businesses to hold them for long periods of time. And their goal is to buy it, increase the value, and sell it to somebody else for more money. So the horizon of that happening may be 3 to 5 years. And we've seen that in some medical group in Chicago. They're on their second or third private equity owner. And some have turned out to be better than others.
Right.
So it goes back to the question of what are you looking for? Is a bird in the hand worth more?
Right. And of course, with any transaction, there's more to think about. I mean, you got to look at the numbers as a whole. I mean, maybe you're getting a buyout, but then you're taking a lower compensation. So over time, what does that total number look like? Is it offset by, that future, that equity that you're holding? It's hard to really look at the numbers and understand what they can mean for you. I guess the only thing is if you get that big paycheck and you're able to put it in your account and you see the number sitting there and growing, that's the only thing for sure, right? We have some doctors who love working for private equity after they're acquired, and others who are not happy, and we can only negotiate so much about their benefits and their compensation. So there's a give and take in those kinds of deals. Do you generally find that your clients are getting an equity, their equity paying out when they take that rollover in private equity?
Yes, and I don't know how much they'll actually tell me if they're happy or not, but some of them, like having the control that they're losing with the private equity. You're not going to have the control you used to have, and that's when they may not be happy. And I'm sure there's some of them like it, some of them don't. I probably, if I have to say, the older one that are toward the end of their careers will probably like it because they just have a few more years not to worry about running the business and then retire. Now, if the younger ones had big plans of growing their own business and running that business, they're not going to be happy. But at the same, then it comes to them, they shouldn't have agreed to the deal. So there's a lot probably politics going on internally there, and yeah.
All right. So when you're working with private practices, are there other tax strategies that you're recommending to them? I know we talked about selling out to private equity, but are there other strategies that they should be thinking of that you work with your clients on?
Well, there is, I can think of one where I've seen that it will be probably at the MSO level, where there can be some cash. It's called like using leveraged partnerships. So we formed this new partnership, which is the MSO, where the physicians will have some ownership in the private equity. The partnership can take a loan from a bank that's guaranteed by the physicians and usually the private equity. And if the physicians take their proceeds out within a certain amount of days, it can be treated as debt finance distributions, which is, the loan will give them basis to take the distributions without being taxed. And they will probably be taxed when they pay the loan off in the future years, but they can take the cash out now and pay the tax later. It's not going to work with everybody, but that is something that I've seen done.
Interesting.
So these are just distributions opposed to a purchase of their interest.
That's right. It's if I remember correctly, it needs to be distributed almost immediately. I think I might have said 90 days, but don't quote me on that. So if you take the loan and you keep it for a few months, then it might have a different treatment. So that's I can't remember the sections right now, but I've seen it done once.
Oh, all right. Interesting.
The reason I asked the question, there's another strategy where you do an installment sale of the practice, basically, and you get the cash up front, but you recognize the gain over a long period of time. And the IRS has actively attacked those arrangements. There have been a number of a lot of litigation involving those.
All right, great. Well, are there any other thoughts that you want to share with our listeners today about, tax concepts they should be thinking of? Obviously, there's no way we can cover the whole realm of ideas. We're really talking with physicians and practices and dentists and other types of professional providers about things they should be thinking of in terms of their practice and, what the future of their practice might look like. So any final thoughts that you want to share?
I think I just want to say one thing is once they start considering selling or any kind of transactions, always I recommend contact your lawyers or CPAs or financial advisors before you do anything. Make sure that you get the best tax treatment or the correct law structure, anything that's there, because once the transaction is done, there's very little that we can do after it's done.
Right. Good advice. David, any final thoughts?
Well, I'd like to add that, we've been talking in very broad terms about these transactions. They're very complicated when you're dealing with private equity firms. They're generally represented by very sophisticated tax counsel and regulatory counsel. And I think that it's it's a mistake to simply think that what they're going to propose as a structure is going to be good for the seller as well as the buyer. And it's important that a seller have their own qualified advisors to help them and get them involved at the beginning of the process, not when you're in the middle. And we have clients who we get involved in the transaction after they've already spent a lot of time talking about the letter of intent. And yes, it's a letter of intent, it's not binding, but in fact, there's been a lot of discussion about how a deal is going to work. And it's going to be harder to go back and reconfigure things to be more beneficial for our client. So get people involved, get your advisors involved sooner rather than later, and leave yourself adequate time to go and get this transaction done in an orderly fashion.
It's great advice. And, I've had clients come with an already signed LOI on substantially sized deals, which can make it difficult. Well, thanks so much for joining us today. This has been really interesting. And we thank all of you for joining us at the Health Law Hotspot. And if you want to find out more about us, you can go to ralaw.com and check out our other podcasts on YouTube at the Health Law Hotspot. Thanks so much and see you next time.
The Roetzel Health Law Hotspot is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Roetzel Health Law Hotspot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Roetzel Health Law Hotspot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.